Underwriting deals is such a major pain point for people. Most don't want to do it, and the people that are good at it are few and far between. That is why after 6 years of being in the industry and buying over 1,200 apartments, using my best-selling multifamily deal analyzer, I created Real Estate Lab, a full suite acquisition software for multifamily investors. We have built a product that helps investors automate their acquisitions and close more deals, all in a cloud-based platform. You can go to realestatelab.com and sign up today using the promo code TAG2 for 10% off your first 12 months. This is David Tupin. Thanks for listening.
Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back. Another episode of the Apartment Gurus coming at you. And today we're going to geek out a little bit on property insurance and talk with Mr. Stuart Moore, who is an industry expert in insurance, obviously sells insurance, but is very helpful in due diligence and other parts of the process. So by way of introduction, Stuart is coming to us from the sunny state of Georgia. What is it? Is that the Peach State?
The Peach State.
Yeah, the Peach State. That's what I thought. And he's actually been an investor in a couple of deals. So we'll talk a little bit about that. But we're really want to talk to Stuart about the insurance side of multifamily investing. So a couple of interesting things about Stuart. He played golf in Division I golf at Auburn University, which is, playing competitive golf at any level to me is just amazing. Such a hard sport. Spent my whole life hacking around at it, and I have tons of admiration for the mentality that it takes to be successful in golf and the discipline. So Stuart's been married for 12 years and he has two daughters, ages 9 and 7. So he also coaches their sports. What sports do your daughters play, Stuart?
Oh man, currently we're in cross country season, which is
okay.
Interesting. But
I loved cross country. Yeah.
It's a lot more fun to watch than I thought it would be. And then we're rolling into basketball season, softball season.
You coach all those?
I'll coach basketball and softball.
Yeah, very cool.
I don't try to coach cross country.
Yeah, run faster.
That's right.
Catch that person in front of you.
Yeah, catch them.
Yeah. No, I remember I ran cross country in junior high school and really enjoyed it. It was really a fun sport for me.
Yeah, I didn't really have much expectation going into it. My wife ran, and we got to that first meet, and we're running all over the place, trying to tell them where to go and catch that person and run faster, and it's pretty thrilling for the 15 minutes they're running.
Yeah, no doubt. Fun races. So Stuart, if you would, for the listener and for myself, kind of give us a little more background on you. You went to Auburn, obviously. What did you do after college? What was your professional life like after college?
So after college, I was a decent college golfer, and then I went and played on what was then the Hooters Tour, tour, which were like AA baseball for golf.
So just a step below like the nationwide tour, or what used to
correct.
Be. What's that called? So, what's that tour called now?
So it's now the Corn Ferry now.
Okay.
And that would be AAA baseball.
Yeah.
So I actually did that. I played golf for for 4.5 years after college.
Wow.
Had a little bit of success, but at the time, that's just a lot of travel. You're not making hardly any money, and it just wears you down.
Yeah.
And I actually had a friend that I knew from golf who was a little older than me that had an insurance agency, and like, hey, if you can still play a little bit of golf and come over here and kind of do the insurance things. Like, I don't care if you come in or if you're gone, but you can try this out, and kind of fell into it that way. And, I did that for about a year, kind of stayed with him. And then when I fully retired from golf, I guess you could say, I was like, man, this is kind of nice. There's no 8 to 5. It's kind of go kill what you, or eat what you kill. And so I was like, okay, this is kind of pretty good gig. And ended up moving to Turner Wood and Smith, where I am now. Been here for almost 12 years, I think, maybe 11 years.
Okay.
And kind of started here as a generalist. Didn't really, knew a lot of people in the community, had friends, called on them, and had a good friend that is involved in a property management company in Atlanta. And we started getting referrals from them on apartment complexes.
Okay.
We get kind of, 3-4 referrals a year. And then maybe 2015 or 16, we started getting more and more referrals. And one of them kind of led to another and another and another. And you get to 2018, 2019, pretty much the only insurance that I did or do now the last 3-4 years, it's just property insurance for apartment complexes. Okay. And it's known all over the country. We were talking a little beforehand, I'm in Georgia, but we write a lot of stuff in Texas, Oklahoma, Kansas, kind of over to Virginia and down.
Yeah.
Kind of that's where we write a lot of stuff. We do a sure deal in Wyoming, but mainly that's where we do it. So it kind of organically grew. We've done several podcasts now. We're talking about going to different conferences, multifamily conferences. We go to a lot of those and get all sorts of leads from people too. And the multifamily world is so small that once you get in with, one set of people, and you do a good job, they'll refer you to all sorts of people. And so that's really kind of the story. I never would have thought, even when I got in insurance, hey, I'm going to write apartment complexes all over the US. It just kind of happened. And one day you wake up and you're like, man, this is a lot of apartments.
Yeah. That's exciting. So by the way, have you ever done anything in Ohio? Just curious.
We've done a couple small deals in Ohio. Nothing, when I say small deals, like we've done a couple of 10 and 20 units. I think one of them was nothing big in Ohio. We
are as most of the listeners will know, our target markets here at Greenlight are Columbus, Ohio, and Oklahoma City. So so I'm eager to talk to you about Oklahoma. Since you read it, it sounds like you do a lot of business there.
Yeah, one of the 2 deals I invested in was in Midwest City, Oklahoma.
Yep. Okay. Yep. So, let's talk about that for just a sec. So, are you a limited partner in those deals? Or are you an active partner?
Limited.
Okay. So you're a passive investor in these deals. Were these just syndicators that you met through the course of doing business and doing insurance?
Correct. 2 different groups, but for me, we'd done 3 or 4 deals for them, and they had this deal in Oklahoma City, or Oklahoma. I guess Midwest City is right next to Oklahoma City, from what I gathered, somewhat close.
Yeah. So you never went to the property, obviously. No,
okay. No, I'm not a very
Man, being the life of a passive investor is so good.
Yeah. Honestly, we did 3 or 4 deals for a group, and I really liked them.
Yeah.
And, we hit it off, and I was like, man, these guys seem like they do a really good job on the stuff that we've seen. And so deals came up, and I was like, hey, are y'all looking for an investor? And they said, sure, here you go. And I actually sent some of the financial stuff to one of the property management guys. Like, hey, what do you think? And he's like, man, that looks good. And I said, okay, let's invest. For me, it's about the people. Same thing on another deal was a different group in Arkansas. And, I like the people. I trust them to do a good job.
Yeah.
I may be the simplest passive investor, but if I like your guys and I've seen some success and I think you're telling me the truth, that's what I need to know.
Yeah. And that's a great takeaway. People invest in the operator before they invest in the deal. Like
1,000%.
They need to know, like, trust you, and especially trust you to be a good operator before they'll even consider a deal, or look at a deal. It's the deal's always second, at least with almost every passive investor. Let me ask you this. Let's deep dive into this for a sec. What was it about these groups that you liked as much as you did? What qualities did they embody that you really were resonant with?
I would say for myself, dealing with them on the insurance side of things, whenever I had questions for them, they were very responsive. Always answer the phone if I had a question for them.
Yeah.
Or as far as the insurance, or, they would try to get the information for me. So that was I always appreciate that. And like I said, that's not even about the deal. That's just them being people.
Yeah.
And I mean, that's really it. And then, like I said, I liked the type of properties they had looked at, even some they hadn't bought. Seemed like good areas.
Yeah.
So, I mean, nothing really other than building up trust with them. And because for me, as an insurance agent, I would think they're doing business with me for the same reason.
Sure.
They trust me to be able to provide the lender requirements and know that they have the correct coverage, because I'm sure they're not digging through the insurance policy. They're going to say, hey,
right,
I have this, this, and this. Kind of the same thing when they send me the deal. I'm like, hey, does this mean this and this? Sure. Okay. Well, that sounds good to me. So two-way street.
Yeah. You like you said, you're very seldom is anybody ever going to read a insurance policy, mainly because it's such, legalese, dense, like hard to understand for the lay person or the sponsor, the syndicator. So, you're trusting your agent that they've read it, that they know it backwards and forwards. They understand all the nuances, ins and outs of the policy and coverage. And, that's a clear position of trust for sure. And so that's awesome that you've established those relationships and have been able to do business together. I mean, that's super exciting when you have those kind of relationships in place.
Yeah, absolutely.
Yeah. Awesome. So let me ask you this. So, from where I'm sitting, we do deals, right? So we go out, find deals, we raise capital to fund the deals, and we syndicate that capital and bring it all together and get deals done. My partner, Carl York, is really our point of contact for our insurance matters. And so I basically, I'll look at what the final cost is going to be and that sort of thing. But I don't really honestly look a whole lot deeper than that. So I guess what are the main variables when you look? Obviously, deductibles one, premiums one, but like and this is going to lead to a bigger question, which is like, how do you compete? Because there are many insurance sources available out there. Obviously we have one, and we use the same agent, for all of our deals, and trust him, likewise. So, it just makes me wonder, like, how do you stand out, right? Like how do you differentiate yourself from the competition?
Yeah, that's a good question. It's for us, it's the same thing that, your agent provides you. It's a relationship, and it's trust, and you got to get in front of these people and put a face with a name. That's why we go to a lot of conferences and constantly putting stuff on LinkedIn to show that you're the guy that knows multifamily.
Yeah.
If you deal with someone who doesn't do a lot of multifamily and you start getting into lender, I mean, the biggest issue we run into is lender requirements. Not really an issue, but they can change your insurance costs significantly depending on who the lender is. They may require a lot more building value than you think, a lot more business income than you think, a lower deductible that's going to drive your costs up.
Yeah.
There are just so many variables. We've started seeing a lot of them now have started asking for $10 million umbrella policies, where it used to be 5. And not that it's a huge cost difference. I mean, a lot of times it's $5,000 to $7,500, but when you're getting down to the end of it, and then you find out, 2 weeks before, hey, here's an additional $7,500 in insurance costs, that there's really nothing you can do about it because the lender didn't tell anybody, or the agent just didn't know that you needed a $10 million umbrella.
Yeah.
And a lot of different things. And we were talking a little more before, like on the offering memorandums.
Yeah.
A lot of people, once they know they're going to make an offer, will send me the offering memorandum and say, hey, take a look at this. And they just want to plug in the $350 a door that's shown that's what their T12 says.
Right.
Well, they may have 10 properties on that policy, and they may have $100,000 deductible.
Yeah.
And they may not have it insured for as much as your lender's going to make you. And it can completely, so their cost could be $350, your cost could be $550 a door. We're talking per door. And I mean, that's just a significant cost. But if you know that up front, if you think, hey, we're going to use $550 because this was our agent says is a pretty rough estimate. And then, hey, it comes in at $525 a door. That's great. Or it comes in at $575 a door. It's not a huge deal.
Sure.
You're planning for, $350 and it's $550. Okay. Well, that's, that can be $20,000 on a 100 unit complex.
Yeah.
Adds up real quick. So so I guess back to your question, it's just getting people to understand that what you're talking about, and you've seen a lot of deals, and some of the pitfalls that may come during the whole process.
Yeah.
It's getting in front of people. It's doing conferences and doing podcasts. And
so the differentiation is really like your niche, your level of expertise in the multifamily space.
Yeah,
and
definitely a niche. If you're looking for multifamily insurance, make sure that they've dealt with Fannie Mae and Arbor and Bancorp and all the different lenders on their requirements.
Yeah. Okay. That makes sense. Yeah. And I think you're super smart to have niched yourself along the way. This is a niche economy now, and you really need to be an expert in one lane, in my opinion, these days to compete, because so many other people are. And then of course the level of like relationship that you have. I would think too, honestly, that, I mean, from where I'm sitting, like having an insurance agent that is our broker that's also an investor and obviously understands the business well enough to have actually invested in this kind of property that you're insuring, that to me speaks volumes as well. That you're, because so many professionals in this space don't participate in investing and owning real estate, right? Like you see a lot of brokers that don't invest in properties, and there's justifiable reasons for that. Some brokers don't want to be perceived as competing with their customers, that sort of thing. So it's understandable, but at the same time, like, being a limited partner in a deal is not really competing with anybody. So, to me, that's a big, feather in your cap, so to speak. If I were out looking for an insurance broker at this point.
Yeah, it's just more of, it's more buy-in and, hey, I trust what you're doing. You're trusting what I'm doing. So, why not try to invest and make some money as well?
Well, and I mean, this is just such a great space for that. And all of the reasons that multifamily investing is so, it's such a unique opportunity, especially given what we're going through right now with, a looming recession, apparently. And a downturn, a softening, a rise in interest rates, that sort of thing. Multifamily really shines during these times because, number one, they typically don't lose a whole lot of value, and the only value that they do lose is due to decompressing cap rates. It has nothing to do with their income or like lowering of rents, right? Like that essentially never happens, especially in growth markets. You don't ever see rents come down. You might see rents flatten. You might see the growth flatten a little bit. But so, as long as you have, good debt terms and can ride through any downturn that we have, you're like, it's a recession resistant asset. And that's for listeners, quick takeaway there too. Like that's a buzzword that you should be using all the time, is recession resistance. And recession proof is going too far, in my opinion. It's investing, right? Nothing is guaranteed. And so you can't say that an asset class is investment proof, but you can point at historical data that shows how well multifamily does perform in times like we're experiencing right now and are probably going to experience. It's such a great hedge against inflation too. And because as inflation goes up, typically rents also go up. And so you're increasing the income of the property and therefore increasing the value, at least projectedly. So just a quick kind of sidebar on all the advantages of multifamily, and we didn't talk about tax advantages or risk mitigation or leverage or forced equity growth, forced appreciation, like all those. All of those qualities just make this space so exciting, and really the reason that I fell in love with the space, was the wealth of reasons that it's such a great asset class. So let me ask you a little bit about Oklahoma, and specifically because I think there's probably some good lessons here. In Ohio, the big variable that we have to deal with is property tax. They've got a crazy situation there where ultra aggressive school boards hire attorneys that go after new property owners and reassess, and property taxes can be massive in Ohio. In Oklahoma, our other market, one of the big variables is insurance. Mm-hmm. And that's because Oklahoma City, has experienced a lot of storms, a lot of natural disaster type scenarios, especially as far as tornadoes and that sort of thing, hailstorms. So talk to me a little bit about the nuances of Oklahoma and what you know about variables in insurance there.
Yeah, I mean, the biggest thing in Oklahoma, and you can throw Texas in there as well, is the weather.
Yeah.
You get all types of weather. I mean, think about the freeze storm in Texas from even 2 years ago now.
Yeah, I think it was 2 years ago. Yeah.
We had some huge claims from that. That crippled a lot of the Texas marketplace and had some carriers completely pull out of the state because they lost so much money on that, because nobody was prepared for that. The weather would be, and then also you get hurricanes, you get windstorms, and not just hurricanes, but just powerful, tornadoes, windstorms, all that. So the biggest thing that you're seeing now is higher wind hail deductibles. So you're seeing 1% for sure. I mean, a lot of them are up to like 3%. So if you think you got a $500,000 building, and you got a 3% wind hail deductible, that's $50,000 deductible for that building.
Yeah. So for not a very expensive building.
Right. So, but that's very typical now. So that's the biggest thing. And then, I mean, a lot of the variables is just the year built. There's so many multifamily deals that we see that are built, in the 60s and the 70s. And I mean, you think about that now, those buildings some of them are 50 years old.
Right.
They're just
original windows, a lot of times original mechanicals.
Right. Yeah. And it's just getting more and more expensive. I mean, a couple of our carriers will not write anything that's not built, that's built older than 1990. So anything 1989 or earlier, they just completely won't insure them anymore. Mm-hmm. Just a hard and fast rule for them. Yeah. So that's with Oklahoma and Texas, you end up with weather, and 9 times out of 10, you're going to end up with what's called an E&S, or excess and surplus lines carrier, like a Lloyd's of London, where it's just going to be more expensive because they know the risk is a lot greater. I mean, we insured a property it was January or February around and I think it was in Arlington, that had $2 million fires in the last 3 years. And I mean, the guy was buying it new, but they ended up paying, it was almost $1,400 a door. I would say, sometimes you can spot it in the offering memorandum if the insurance cost is really high. You're like, why is it showing so high for the T12? There's probably been some sort of loss. Yeah. There's a reason they're paying that much. And, whether fair or not, that's going to reflect on your terms as well, because you're going to have to get those loss runs and show, hey, this property had a big fire or had a big windstorm, and your rates can be higher as well. So, yeah.
And that's just, I mean, a fire is a windstorm. I get a fire is generally started by a tenant, not doing the right thing. Right. So yeah, it does seem a little unfair. It is that a fire or a couple fires would stigmatize a property and in the eyes of insurance carriers. One
way to combat that a little bit is to make sure your tenants have renter's insurance. and there are different programs out there.
Yeah.
Where, you can purchase the renter's insurance for them.
Right.
What it does is you'll have a limit of liability of, say, most of them come with about $100,000 of liability, where if they cause a fire, say, it's not going to make a big difference if it's $1 million fire, but say it's a $75,000 fire, your company can then subrogate back against that policy for the liability. So it comes out better for you and your insurance company, where they have somebody to go back against if it's their fault.
Sure.
They, left a tenant cooking or something like that.
Right. Right. Obviously, weather events seem to be pretty commonplace these days. It kind of begs the question, when you see a freeze storm in Texas like we saw, that was just nuts. And we've got frequent hurricanes, that sort of thing. What do you hear? I'm sure you got your finger on the pulse of the industry. What do you hear in the way of like where we're headed with this? It seems like, we can't be headed anywhere but just more and more expensive policies.
I know. I've talked with several underwriters, and it's on the property insurance market in the last year has just gotten insane. If we get increases that are 10% or less, that's really good.
Mm-hmm. Wow.
They're typically, they can be 20, 30%.
Yeah.
And, the best thing that we try to do is, if we're getting a big increase, is get it to the client as early as you can. Just because you can say, look, here's what I got. This is my best option. And if you have another option, you want to try to find another one, you're not going to hurt my feelings.
Sure.
But this is the best that I can find, and the best that I'm being told is in the marketplace. But it's not slowing down. We're obviously in Georgia, so we write plenty in Georgia. In January, February of this year, rates in Georgia were $450 a door. And we've written several deals now in the last 2-3 months that are $600 plus a door.
Yeah. Wow.
Especially around Atlanta. A lot of metro areas in the Southeast have gotten really expensive. Yeah. Nobody seems to have an answer on when it's gonna slow down.
Yeah. How could you, like it, you can't predict the weather, and all you can do is kind of look at the trends and pulling out your crystal ball on something like that is really impossible. So renter's insurance, is that something that you coordinate with property owners as well?
We can. There are a couple programs out there that you can put it in for people. And then, a lot of times we tell the owners, hey, make sure your people have renter's insurance.
Yeah.
And because to get like a program where you buy it for them, you really need to have probably about 1,000 units or so.
Okay.
North of that, you can start looking to, there are a couple people that will put it in for the whole thing. And, it's a whole process where you purchase it for them. And that's when the numbers start making sense. Below that, there's just a lot of administrative costs for these things.
Yeah. Okay.
But that's a really good idea. If you've got a 200 unit complex, put it in the lease that they have to have renter's insurance.
Yeah. And you're allowed to require that, right? As landlord.
And as far as I know, I don't want to get any of the legal. I would assume yes.
The two deals that you're in, are they requiring tenants get it themselves, or are they lining it up for them?
They just have the tenants get it themselves.
Got it. Okay. Got it. Does that affect rates at all on the property policy?
They always ask. I don't know that there's a significant savings, but it helps.
Yeah. Okay. Got it. Understood. Awesome. Curious what your thoughts are on investing moving forward, or is that something you're planning on continuing to do?
Yeah, definitely. The couple deals, they seem to be going well. And the only thing I've seen here lately is, and I'm sure plenty of audience have seen it, a lot of these deals that are closing, they keep getting pushed back, which I'm sure is a lot to do with the rising interest rates. And
yeah, the debt market's crazy.
Yeah. And I keep hearing that. I'm not personally involved in it. So, but I mean, we've had several deals that have floated out there for, a month or two past when they thought they were going to close just because of debt terms. So,
yeah.
I've always, like I said, for me, it's more of the operators, the two groups that I've dealt with. They hadn't closed anything here in the last month or two. So I just really hadn't had any opportunities.
Yeah. Yeah. I mean, you keep doing that, and you're obviously not too terribly old of a gentleman, based on the math I did in my head. You've been working for 12 years or so since the golf tour days. So, you keep doing that, man, you're going to be set. You don't need me to tell you this, but the cash flow and the particularly the equity growth, the wealth building through what you're doing. I mean, that limited partner spot in these deals, in my opinion, is absolutely the best spot to be in. You get paid first usually with a preferred payment. And you get paid before any of the other investors, the general partnership does, and you get paid the most. The equity splits are usually 60-40 to 80-20 in favor of the limited partners, the passive investors. So, you own a majority of the deal. There's all kinds of risk mitigation involved in that. And, it's a sweet spot to be in, of course, in the right deal. You want to be in a winner for sure.
I mean, I would highly recommend it. I mean, like I said, I've looked at the monthly stuff they send. It looks good to me, and just kind of file it away. And I got a little folder on my desktop. I just drag it over there and, don't really think anything about it. So I would highly advise anybody that's thinking about it that, trusts who they're being contacted by or looking at, I would highly recommend doing it.
Yeah. Yeah. I mean, so, and listeners, we've talked about a lot recently about the different ways to get into multifamily investing. And I think one of the very best ways, if not the best way, is to invest as a passive investor in somebody else's deal. You're going to learn, especially if you invest with somebody that you have a really good relationship with, and can kind of you kind of maybe friends, or you have a good enough relationship that syndicator is going to include you in asset management meetings, important email threads, like basically, so you learn the business from the inside out as a participant. And it's in my opinion, hands down, one of the best ways to learn. Plus you're, in most of these syndications, you're going to double your money in 3 to 7 years. So,
right.
There's that as well. Like it's a really good place to put your money. So, awesome. Anything I haven't asked you about, especially about insurance here, that I should have? It's, to be completely candid, it's not my area of expertise in our business. And, I'm a deal guy, and I'm usually out front getting the deals put together. So I don't spend a whole lot of time on it. So I just want to make sure I've asked all the important questions.
Yeah, I would say one thing that's really become a hot button issue over the last couple of years with within not the property insurance, but the general liability insurance is assault and battery coverage. It's kind of in the Southeast, it's been kind of an issue where as if somebody is assaulted or, we see shootings or a stabbing on your property, the carriers are tired of paying the personal injury lawyers.
Okay.
You're seeing a lot of sub limits, whereas so you'd have $1 million for general liability. You may have a sub limit for assault and battery that may be $250,000.
Okay.
Meaning, if something like that happens, you only have $50,000, you don't have $1 million. That's just something that I would advise every person to ask. Ask the agent, who it is. Hey, does the general liability include assault and battery? If you're with, somebody like Nationwide or Travelers or somebody like that, it's going to be included. But you get into some of these other markets that, like we're talking about excess and surplus lines markets, it may not be fully included. And we see more claims for that type activity on the general liability. I mean, we see more of that than we do fire claims.
Got it.
It's just something to, people need to be aware of that and at least ask, hey, does this have assault and battery coverage?
Yeah, that's a great question to be asking. Awesome, Stuart. Well, sure appreciate all of the expertise that you brought to the show here, and all your knowledge and experience, and again, like that asterisk by your name that says I also invest, like that to me is very powerful. So
yeah, that's good to hear.
Yes. One last thing I want to highlight, Stuart a couple times has mentioned the national conferences that he goes to. And look, in my opinion, listeners, there is nothing more powerful than flying to Dallas or Orlando or Denver or Vegas or wherever, and spending 2.5, 3 days in a room filled with people doing what you're doing, a lot of times at a very high level. And, and that room's also filled with money and potential partners and investors. And so like that, that it is, and not to mention all the speaker content, which is usually very, very high level. So, go to these conferences is the takeaway here. Like, there's 3 that I highly recommend. And if you email me, I will, I'm happy to share with you, the 3 episodes or the 3 conferences that I think are like, do not miss conferences every year. And so like just go. Like the couple $1,000 you're going to spend on airfare and hotel and the tuition to the event, is some of the best money you'll ever spend, in my opinion. Partnerships get made there, clients get found there, investors, you connect with investors there, capital raisers, co-GP type people, not to mention all the industry specialists like Stuart, the insurance, the brokers, the property managers, all those vendors. So anyway, dude, this has been great. Really appreciate everything that you shared and brought to the show. If listeners want to reach you and get a quote on a deal, what's the best way for them to reach you, Stuart?
Best way is just to email, and that's just my name, Stuart.Moore, and then that's at TWS Turner Woodsmith Insurance.com. That's the best. And then always they can call me. Direct line is 678-928-6700. So those are the best ways. And I try to be active on LinkedIn. You can find me there. I've found that's a good medium for multifamily stuff too.
Absolutely. So one last big takeaway. If you're not on LinkedIn and working it, and particularly creating content, you're missing a really great free opportunity. And it's again, LinkedIn is vibrant. Like, it's happening. People are active there, and people are doing business there. So you absolutely want to be present there and working it. So, all right, Stuart. Well, thanks again. Really appreciate you and wish you all the best. I'll see you at the Best Ever conference if our paths don't cross before this winter. It's in our hometown here in Salt Lake City. So yeah, and appreciate you being on the show, man.
All right, thanks. I appreciate it. Thanks for having me.
You bet. And listeners, thank you. Appreciate you guys hanging out for another episode of the Apartment Gurus podcast. Just exciting to share this stuff with you and to have these gurus on the show that add so much value to what I'm up to, what my company's up to, and what you guys are up to as listeners. So hopefully this is all elevating your game. We're doing 2 episodes a week now, really trying to get as much valuable content out as we can. And so hopefully you're getting a lot out of it. Leave a rating and review if you feel so led. That helps us out a lot, like more than you know. And we appreciate it. So thanks again, everybody, and we'll see you on the next episode.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of the Apartment Gurus.